So here is the question. Here is what? Here is the question. Here is what? Here is the question. Let's go back. The question is saying project cost $600,000. Was the cost of the project $600,000? Project cost $600,000 and it went for 7 years. Sales, you have 100. You have 10,000 units in the first year, 13,000 units in the second year, 15,000 units per annum in year 3, 4, 5, 6, and 12,000 units in year 7. Selling price is $40 per unit. Material cost is $3 per unit. Labor $8 per unit. Variable overheads $2 per unit. Fixed overhead $10,000 per annum. Tax rate is 30%. Discounting rate is 10%. Discounting rate is 10%. Required. Find NPV if tax is paid in the same year. And 2, NPV if tax is paid in arrears, 1 year in arrears. Find NPV if sales are 100, if sales are 10,000 units, if sales are 10,000 units per annum and will last forever. So this is the question. You have 3 requirements, very easy to do. 3 requirements. All you do first, you always know that in doing your NPV, what do you have to know? In doing your NPV first, you always know that in doing your NPV, you have your table to consider. So requirement number one, you have this. Requirement number 1, you're going to say, first you have 7 years, right? You have how many years? 7 years. Okay, and tax is being paid in the same year. So if that's the case, pay attention. If that's the case, you want to start with year 0. You go to, you say 3 to what? 6, and year what? 7. I'll tell you why. Now, the first thing you do is say you bring your investment. What is your investment? The first thing you do is to bring what? Your investment. What is your investment? Your investment is what? $600,000. Okay, $600,000. The next thing you bring is your revenue. Okay, your revenue. How are you going to calculate your revenue? How are you going to calculate your what? Your revenue. Now, to calculate revenue, what's your sales for year 1? In the first year, what's your sales? You have 10,000 units sold. Okay, your sales is what? 10,000 units. And what's the selling price? Definitely your selling price is $40 per unit. So 10,000 times $40 per unit. So look at it. Here you say what? 10,000 in the first year times $40. So having that one, 10,000 times $40, what will you get? You just, so year 1, sorry, you adjust your table again. Yes, so we adjust our table. We forgot to insert year 1. So our table should be year 0, 1, 2, then we get the rest. So it will be in year 1. So you're going to say year 1, 2, now 3 to 6, then you have what? 7. Yes, this is the perfect table. I'll tell you why we have it this way. Now, you have your what? You have your investment. The first thing you bring is your investment. Year 1, 400,000. That's your revenue. Let's have it in the same line. What's your revenue in year one? What's your revenue in year one? Your revenue in year one. Your revenue in year one will be what? Good. So year one, your revenue is 400,000. Your revenue in year one is 400,000. Your revenue in year one is 400,000. How about year two? What will be your revenue in year two? So year two, you sold 13,000 units. So when you calculate that one, it's gonna give you 520,000. 520,000. That will be your revenue. So your revenue from year three to year six now. Why are we doing year three to year six instead of getting them separately? We are doing it this way because, listen, we are doing it this way because we discover that things seems to be constant year three to year six. We are doing it this way because what? Things, cash flow seems to be constant. All the activities seems to be constant from year three to what? Year six. Take note. So now, so year three, we are saying year three to year six, we are saying 15,000 units were sold, or sales is 15,000 units at 40. So that is what you need. So when you do sales 15,000 units at 40, you get 600,000. Okay, 600,000. Then you go to year seven. Year seven, 12,000 units at 40. What will you get? 48,000. Let's say 480,000. So this is how you have it. Let's have it this way. The next thing you consider is what? Your materials. Next thing you consider is what? Materials. You now consider your cost. After revenue, you take out your cost. The next thing you consider is materials. So having materials. So materials, what's the cost of materials? Materials, remember in the question, is $3. Okay? $3 per unit. $3 per unit. And how many units have you produced in year one, two, three to seven, and year seven? You multiply it by those ones, then you get what? Your materials. So for year one, so far materials will be what? $30,000. $30,000. Year two, what will it be? $39,000. It will be what? $39,000. It will be what? $39,000. Year three to year four, what will it be? 15,000 times 15,000 times what? 15,000 times $3 per unit. It will be what? $45,000. To be what? $45,000. And 3,000 times 12,000. This one will give you what? $36,000. $36,000. I hope this is fine. The same approach you use for labor. Your next step is to take what? Labor. Your next one is to what? Take labor. So now you're looking at labor. What is the labor cost? Labor cost in our question here, for labor, it's $8 per unit. For labor is what? $8 per unit. For labor is what? $8 per unit. So you check how many units have you in year one, two, three to six, and also in year seven. You multiply it equally. Okay, each one you multiply it that way. So year one, for your labor, you have what? $80,000. $80,000. Year two, you have $104,000. You have $104,000. Year three, you have year three to year six, $120,000. $120,000. And year seven, you get $96,000. Okay, when you multiply the $8 per unit times your 12 in the last year, then that one you'll get it. Now, what's the next cost? You're done with labor. You look for the next cost, variable overheads. That's the next cost. Your next cost is what? Variable overheads. What's variable overheads? Variable overheads is $2 per unit. And you would also take that same route, $2 per unit times year 1 unit, year 2 unit, year 3 unit, or year 3 to year 6 unit, and year 7 unit. Okay, having done those, so year 1 you get 20,000. Okay, year 1 you get 20,000. Year 2 you will get 26,000. Year 3 to year 6, year 3 to year 6 you get year 3 to year 6 you get $30,000. And year 4, what will you get? You get $24,000. You get $24,000. Hold it this way. What's our next cost? Our next cost is fixed overheads. Okay, fixed overheads. Our next cost is what? Fixed overheads. It is saying fixed overheads is $10,000 per annum. Now, it means $10,000 per annum throughout. So year 1, 10,000. Year 2, year 2, 10,000. Year 3 to year 6, 10,000 throughout. 10,000 throughout. And final year also 10,000. Have it that way. So are all the costs finished? Yes, you look thoroughly and see if you have not left out any cost. You have to be very mindful and careful. Look for all the costs, which is why you have to read the question at least 2 times, and you're able to comprehend exactly the cost and everything in there. So the next step, after getting all these ones, the next step, you find what? Your taxable profit. Okay. Next step is to get what? Your taxable profit. So you say what? Taxable profit. So taxable profit. Your next step is to get taxable profit. Still don't forget, bring your investment. Don't leave it behind. Okay. The worth of your investment. Bring it. Don't leave it behind. Okay. So you year 1, you're going to subtract from the revenue all the expenses. You're going to subtract. When you do that one, you get 260,000. 260,000. For year 2, you do that one, you'll be left with 341,000. And year 3 to 6, when you do that one, you'll be left with 395,000. 395,000. And year 7, the 7th year, you'll get 314,000. This is what you have for now. So your next step is going to be what? Your next step is going to be considered your tax. You're going to consider what? Your tax. You're going to consider your tax. This is taxable profit. Immediately after taxable profit, it is saying the profit that should be taxed. And how do you get your profit? Definitely selling price minus cost. You can see your revenue minus cost. Then you have your taxable profit. Here, so you say tax. What's your tax in this question? 30%. Remember, it's based on the tax rate given to you. Tax rate can be 20%, 25%, can be 40%, whichever. So always look at the tax. So far, we have been solving, all our tax rate has been 30%. Doesn't mean that tax rate is always 30%. You look at the policy for that year or what is in the question, then you go with that. Okay. So tax rate, 30% of each of these ones. Remember, the first requirement is saying tax is paid in the same year. So if tax is paid in the same year, then what do you have to go with? So remember your investment is not tax. Your investment is what? Not tax. So you look at year one, what will be your tax rate? 30% of 260,000, 30% of that, it will give you 78,000. To give you what? 78,000 tax. You need to subtract it. And 30% of 341,000, it will give you 10 to give you 102,300. Give you this one. And year 3 to year 4, 30% of it, it will give you 118500. 118500 tax is 118,500. Then at year 7, what will that give to you? It will give you 94,200. So this is your tax. Same year, remember? Don't forget tax the same year. Remember, tax the same year. Remember, don't forget that one. Tax the same year. Remember, you have that one. Okay? Tax is paid in the same year. Now, tax is paid in the same year. Now, you go with having got the tax. Is there any other income, cash inflow, outflow? There's no scrap value in this question. Then you just go with what is given to you now. So you deduct your tax from your tax. What do you have? How do you call this one? Class, how do you call this one? Tax is deducted. How do you call this one? How do you call this one? You call it net cash flow. NCF, net cash flow. It's called what? Net cash flow. It's called what? Net cash flow. So your net cash flow, you bring your investment. Don't forget always your investment is along. So your net cash flow, to deduct these two, your net cash flow for year one will be 182,000. 100 and what? 182,000. And for year 3, year 2, it will be what? When you deduct it, it will give to you 238,700. 238,700. And the other one will give to you 276,500. 276,500. Then lastly, you will get what? 219,800. 219,800. This is your net cash flow. Okay, look at it. Now we are about to move into another dimension. Okay, we are about to move into another dimension. What's the dimension? This is your, after getting your net cash flow, the other one you consider, your next step is your discounting factor. What's our discounting factor in this question? Our discounting factor in this question is 10%. What's our discounting factor? 10%. You look at the question, it's there. 10%. 10% is your discounting factor, this one. Are you seeing it? 10%, your discounting factor. That's your discounting factor, 10%. Good. Now, at year 0, it's always 1. Remind you, at year 0, it's always 1. So you look at your present value table. 10% at year 1, it's 0.909. And 10% at year 2 is what? 0. What? 826. How about here? How about here? How about here? Look at this one. You cannot use your annuity you cannot use your PV discounting factor here. You cannot use it here because you have a constant cash flow. Since you have a constant cash flow, for how many years? For 4 years. You have a constant cash flow for 4 years, but it is not starting with year one. It is not starting from year one to year four. It is starting from year three to year six. So though you're having the sixth year there, it doesn't mean that it is 6 years cash flow. Okay? You're looking at year three, year four, year five, year six. So it is 4 years cash flow. But remember, it is 4 years cash flow. So what do you do? Since the cash flow is constant, you go to your annuity factor and take that one. But though it is 4 years cash flow, you're not going to take the annuity factor for at year four. You're not going to do that. You're still going to observe annuity factor at year six. That is what you observe. But look what will happen. Look at this one. So you go to your annuity factor for year six. So first you say what? Year six. First you're going to say year six. Wow. First you're going to say year six. First you're going to say year six. The camera clear. Okay, we still can pause the light cam. They will continue, just that the recording will continue. When I am recording it, I'll cut it from here. Let me see over there. Let me square. On this one, let me see. Just don't touch the camera, just leave it. Okay. Give a shadow from the background. Okay. Give me that one. Put two phones down here. Background. Put it down on the floor, just on the floor. Here. Give it to me. No, give it to me. No, take your phone. Just here. For that shadow. Give me the other my phone. That other one. Yes, yes. Give me that one. So maybe we can continue still and see. Not too okay. The shadow is still showing. Okay. Because this one will become dim over time. Okay, we continue. We continue and continue. So now, yes. So look at this. Look at this. Look at this. Look at this. Pay attention. You go to your table. You go to what? Your table. Now look at this. Go to annuity factor table. Go to what? Your annuity factor table. AF. So in your annuity factor table, your annuity table, you're going to look for year 10, 10% at year 6, 10% at what? Year 6, 10% at what? Year 6. So you're going to say year 6. This is your AF. Year 6 AF. AF at year 6. What do you have? Year 6 AF, you have 10% at year 6 is going to give you 4.355. 4.355. This is for year 6. But remember, you're not going to use it. Remember what? You're not going to use it. Remember what? You're not going to use it. You remember what? You're not going to use it. But how is it useful? How is it useful? It's useful in this manner. You say what? 10% at year 6. Now, you have to take off year 1 to year 2. You have to what? Take off year 1 to year 2. You can either add these two and subtract it from this 4 you have, or you take annuity factor for year 1 for year 2 and subtract it from annuity factor of year 6. So when you go to your table, annuity factor year AF, year 2, annuity factor for year 2. What do you have? Annuity factor for year 2. What do you have? Annuity factor for year 2. What do you have? Annuity factor for year 2. What do you have? At 10%, you have 1.7, 1.736, 1.736, 1.736. This is the annuity factor for year 2. Now you can get the remaining. So when you calculate the remaining, will be, you will get 2 point, what you will get 2.620 or 621. Okay, rounding up, 621, get 621. So calculate that, you get 621. 4.355 minus 1.736. Okay, minus 1.736. What will that give to you? It will give you 2 point. Okay, yes, I see. To give you, when you do both of them, it will give you, when you do them, when you do it that way, it will give you 2.619. Okay, this is what you get. So here you're going to use 2.619, 2.619. This is what you're going to use. Now listen, this annuity factor still, listen, still turn and see. Now listen, this annuity factor you're using, okay? This annuity factor you're using, listen. You have, let me go over again. You have year 3 to year 6, cash flow was constant. So immediately we say cash flow was constant, things were constant. What do you use? You use annuity factor. But year 3 to year 6, though it's the 6th year, doesn't mean that the cash flow is for 6 years. The cash flow is for 4 years, starting with year 3 to, no, starting with year 3, year 4, year 5, year 6. 4 years. But do you take the cash flow for, do you take the annuity factor for year 4? No. So we are still on year, the 6th year. So what you do, just to get the annuity factor for just 4 years, what you do is to take first the annuity factor for the 6th year. Then, year 1 to year 2, we're having their own discounting cash flows. But just go to annuity factor for year 2. You take it off. Then you'll be left with annuity factor for the 4 years, ranging from year 3 to the 6th year. That is what happened here. Okay, that is what happened here. So now we go again to the 7th year. We go again to the 7th year. Now the 7th year, you can go to your discounting table. Just go to your discounting table and take for year 7. Just go to your discounting table, present value table. Present value table you take for year 7. So present value table at year 5, at year 7, it's going to give you 0.5, 0.513, 0.513, 0.513. Now 0.513 now. But you can also say, okay, I want to take the annuity factor for 7th year. which is going to be the annuity factor for year 7 at 10%. The seventh year annuity factor for year 7 will give you 4.868. Going to give you 4.868. Okay, 4 point what 868. So what you do, what you do is to take off the annuity factor for the 6th year, 4.355. So when you do this one, definitely you'll be left with 0.513. And do it. You can do it this way again. It's okay. So this is how we get discounting factors. Okay, I think this is the technical aspect of this question. So you know how we got them. Go over again and see exactly how we arrive at these ones if you don't understand. Now, please don't forget to subscribe, to share, to like, to comment. Okay, thank you. So as we proceed, going further, what do we do? Our next step is to get our present values now. Our present values. Our next step is what? To get our present values. Our next step is to what? To get our present values. Take note of the discounting factors, then I will efface that side and we continue. Okay. Okay, you can still continue. You can still continue. Now, you get your present values. You get what? Your present values. Your present values, your present value of your cash outflow, your investment at year 0, time value of money has no effect on it. So if that's the case, time value of money has no effect on it, you're gonna look at the year 1 now. So when you discount it year 1, when you discount that one year 1, what you will get is 165,000, 165,000 for 165,000 for 438, 164,000 438. Now, the next one, what you get 1971, 197,166.2. Oh, without decimal. When you discount, when you go to year 3 to year 4, you have 276,500 multiplied by 2.619 619 is will give to you 72,724,153.5. Okay, 53.5. This is what it will give to you. Then lastly, you will get 112,757.4. This is what you get. So your next one now is to get what? Your NPV. The next one is to get what? Your NPV. The next one is to get what? Your NPV. So your NPV now would be your NPV. Your NPV. You add all of these ones. All of these ones you add all of these ones, all of them, add all of them, add everything. Then you subtract the 600 investment. That is what you do. So when we do that, when when we do that, when we do that, when we do that, when we do that, what will happen? What we will get when we do that? Basically, we will get, let's say, calculate 6, 1, 6, 5, 4, 3, 8, 1, 6 by 4, 1, 6 by 4, 3, 8 plus 19, 71, 66.2 plus 7, 2, 4, 1, 5, 8.5 plus 1, 1, 2, 7. Come on, this seems to be higher. 1, 2, 7. Yeah, 1, 1, 2, 7. Okay. 1, 1, 2, 7. 1, 1, 2, 7. 1, 1, 2, 7. 1, 1, 2, 7. 5, 7.4. Just a minus 600. 599. 7. So this one will give to you 599. 599. 515.1. So what do you do here? This is positive. Accept the project. Okay, you accept the project. So this is the B A part of the equation. This is what? A part of the equation. This is what? A part of the equation. This will be A part of the equation. So copy this one and we do B part of the equation. Continue. So okay, thank you. Now for B part of the equation, when tax is paid in arrears, okay, tax is paid in arrears. Immediately tax is paid in arrears, something else happened. Okay, something else happened. So now let's see. We need a fresh and a new page for that. Take note of this question so that you have it along. Take note of the question. So immediately the tax is paid in arrears. Immediately the tax is paid in arrears. What will happen? So if tax is paid in arrears, so tax is paid in arrears. So this is this is what requirement two is what requirement two. Tax is paid in arrears. Tax is what? Paid in arrears. Requirement two. Tax is paid in arrears. So now tax is paid in arrears. Immediately tax is paid in arrears, it means the cash flow is not going to be constant again. Something is going to shift. And because it is going to shift, it is advisable for us to get each year separately. Okay? Because something is going to shift. Now, you have how many years? First, you have investment. Start with this one. Investment. Year 0, 1, 2, 3, 4, 5, 6, 7, 8. Year 8. Yeah? Year what? Year 8. Year 7, year 8. So you have these ones. So now your investment. What's your investment? Your investment is $600,000. Your investment is what? $600,000. $600,000. So here now you have your revenue. So what's your investment? Your investment, you say $600,000. Okay, this is your investment. Next, your revenue. What's your revenue? Next, your revenue. Your revenue, remember, when you do your revenue, you have $400,000, 400 for year one, $400,000. What will be the revenue for year two? $520,000. What will be the revenue for year three? Year three, year three will be $600,000. Year three will be what? $600,000. Year four as well, $600,000. Year five will be $600,000. Year six will be $600,000. Definitely year seven you will get $480,000. This is what you get, $480,000. Year eight, there is no year eight, but why we use we extended to year eight, it means it's because we are hearing the word arrears. Okay, when you hear the word arrears, shift 1 year backward. Now, 1 year ahead, I mean. Now, the next step is to get your materials. Okay, the next step is to what? Get your materials. The next step is to get materials. The next step is to get materials. The next step is to get what? Materials. So you say materials, materials. Materials for year one, what was it? Materials for year one, you had 30,000. Materials for year two, you had 39,000. Materials for year three to six, 45,000. Okay. And what was the materials for years seven? 36,000. 36,000. So what was the next thing? Labor. Labor. The next one was labor. What was labor? Remember, labor was what? $8. And doing it, you got 80,000. The other one was 104,000. Here you got 12,000 now throughout, 120,000, I mean, throughout, 1,000, 120,000, and finally here you got 96,000 for labor. Basically, we are just doing the same thing, but we are expanding it this time. We are putting them separately, okay, instead of making them one and we find an UT factor. This time around, we are doing them separately because something changed in the question and things were no more constant for those 4 years. Now, the next one is you got variable overheads, variable overheads, variable overheads. You still bring those figures, but in year 3 to year 6, you put them separately. Variable overheads, you got 200,000, you got 20,000, I mean, you got 20,000, 20,000 year 1, year 2, you got 26,000, year 3 to year 6, you got 30,000, 30,000, 30,000, 30,000. You got the final year, you got what? 24,000. You got what? 24,000. Final year, you got 24,000. And your fixed overheads, okay? Your fixed overheads, you bring it, your fixed overheads throughout 10,000, 10,000, 10,000, 10,000, 10,000, 10,000, 10,000. It was 10,000 throughout per annum. So you have these ones. These are your costs and everything. What you do now, the next step is to get your what? Taxable profit. Taxable profit. Taxable profit. Your next step is to get what? Your taxable profit. So your taxable profit, so taxable profit, you still bring the worth of your investment. What is the worth of investment? $600,000. $600,000. Remember, everything here is in $1,000. Okay, so the worth of your investment is what? $600,000. This is what you bring here. So now the worth of your investment, $600,000. $600,000. You add this one, you get same figure as you did, 260,000, 260,000, and here you get, this is 260,000, please. Here you get what? The next one you get 341,000. Okay, this time around now you get 395,000 here, 395,000 here, seems the same, 95,000, 395,000, 395,000, and lastly you got 114,000. So far what you have done basically is to just separate them. Okay, you remember in our first question we had, like, we had year 3 to year 6, the cash flow there you use one figure throughout, okay, for all of the years. But now you've did those same figures, you place them in separate years. Okay, those same figures you have observed why those same figures you have observed why the reason, because this is now the reason, because the tax was paid in arrears. Now if tax is going to be paid in arrears, it means some things are going to be shifted. Tax is going to be shifted. So because it is going to be shifted, if you place them just for 1 year, then you not do justice to the discounting figures. Okay, you not do the justice to the discounting figures. So it's better, as long as there is a slight movement, don't do, even or if all the cash flows are constant, as long as there is one variable there that is going to be something else that is going to shift, don't do your annuity factor, put them separately. So this is what we are doing now. Yeah, so now this is your taxable profit. So far, your what taxable profit? We have tax. What is tax? Tax is 30%. 30%, but it is in arrears. 30% in what? Arrears. 30% in arrears. 30% in arrears. What does that mean? It means the 30% we are calculating for this year one, 30% of year one. What will 30% give to us? So 30% of year one, 260,000 will give us 78,000. This amount we are paying here in year two. Year two tax will take it to pay, will pay in year three. Year three tax will take it and pay year four. Year four tax will take it and pay year five. Year five tax will take it and pay year six. Year six tax will take it and pay year seven. Year seven tax will take it and pay year eight. That is what it means when tax is paid in arrears. Okay, good. Now let me apply that. So 30% of 260,000 is going to give you 78,000. Is a tax. Okay, it is what? A tax. So we take it off. It's an expense on us. So now, year two tax, when you calculate it, 30% of it is going to give you 102, 102, 300. Okay, going to give you 102, 300. Year three tax, 39, 5,000. When you calculate it, it's going to give you 1185. Remember 1185 on the 1185 on the 1185 on the 118500. Yeah, 118500, not one. Yeah, 118500. Gonna give you 118500. Good. 118500. Okay. And year four tax. When are we paying? Year five. So year four tax, it will give you, year four tax will give you the same 118500. Year five tax, you pay it year six, we give you 118500. And year six tax, you're gonna pay year seven, 118500. And year seven tax, year 7 tax you're going to pay in year 8, you're going to give you get 94,200, 94,200 in year 8. Okay, to give you 94,200. Now somebody might say it's not that shifting. No, it is. Look here, here, if you had paid, look at it, year 3, you now have different figure. How would you have adjusted for this one if you make year 3 to year 6? You not be able. Then also remember, you these years they will not be able to reflect these figures because all of these ones will, in fact, there will be no difference between your solution 1 and this one. So which is why, yes, you not be able to reflect them here. This entire one will be shifted just here in the, or in the 7th year. You understand? It will be shifted in the 7th year, and these ones will not be reflected. Only this one will be reflected here, and that will not be good. Not be good. So because of that, you have to put them separately. So your next step is now to find your NCF, your NCF, your net cash flow, your net cash flow. So your net cash flow, you bring your investment 600,000. You bring what? Your investment 600,000 here. The investment of 600,000. Here you still have your 260,000, and year 2 you will get 263,000, 263. You get 263,000. Year 3 you get that was year 2, and year 3 you get 292,700, 292,700, 292,700. Year 4 you get 276,500, 276,500, 276,000, 276,500, and here as well you get 276,500. Here you get 276,500, and year 7 you will get 595,500, and lastly the same figure in bracket 94,200. You get it. So your next step is now to find your discounting factor, DF. Remember your discounting factor is 10%. What's your discounting factor? 10%. What's your discounting factor? 10%. So 10% at year 0 is always 0. Okay. 10% at year 0 is always 1, not 0. I mean, so 10% at year 1, 0.91909. 10% at year 2, 0.826. 10% at year 3, 0.751. 10% at year 4 gonna give you 0.683. 10% at year 5 is gonna give you 0.621. 10% at year 6. 10% at year 6 is gonna give you 0.564. 10% at year 7 gonna give you 0.5 13 by 10% at year 8, gonna give you 0.467. So basically this is what you get. So your next step is to get your PV, your present values. Your next step is to get your present values. Your next step is to get your present values. So in getting your present values, uh, PV, getting your present values, you still bring your investment. So present value for year one, you get to 36,000 to 36,340 to 36,340, and the next one here you get 21,700 21,728 at year 2, and year 3 you get 21,918 21,918, and here you get 18,888, 18,849, you can say 50, 4.49.5. Next one you get, when you multiply it, you get 171,406.5, and the next one you get 155,155,946, and the next one you get 100 and 100, 29, 400, 291,92,000, and lastly you get bracket 43,000. You get what? 40,991.4. This is what you get. This is what you get. Now your NPV, after doing it all, your NPV will be what? Your NPV will be 6461,97.8. So this is positive. What do? You accept the product. So far do you have been able to do something on this one. You have been able to look at your NPV this way. You have been able to look at your NPV this way, and when tax is paid in arrears. So copy this one, then we look at the third requirement. Okay, the third requirement. Copy this one, we look at what the third requirement. Thank you. So we are back. Let's look at the other aspects of the equation briefly. Yes. Let's look at the other aspects of the equation briefly. That's very short. So now go back to the other aspects of the equation. We can go back to the other aspect of the equation. Look at the other aspect of the equation. The other aspect of the equation, what is it saying? It says, it says, find NPV. It says what? It says, the other aspect of the equation is saying what? It is saying, find NPV if sales are 100, if sales are 10,000 units per annum and will last forever. So in that case, it's very simple. In that case, it's very what? Very, very simple. In that case, it's very, very simple to do it. So in that case, it becomes very, very simple. So now, you know, this is perpetuity. This is what? Perpetuity. Eh? So this is perpetuity. So it goes forever. So you just say investment. You say year one, year zero, that's for the investment. Then you have one to infinity. One to infinity. So one to infinity here, what's your investment? What's your investment? $600,000. Yeah, that's your investment. And one to infinity, they are saying sales. What sales now? 10,000 units, one and forever. Hmm? Okay, you get what? Revenue first. What do you get? Your selling price. So remember here at this one you get selling price SP. What's your selling price per unit? Your selling price per unit. What's your selling price per unit? $40 per unit. Materials is what? Materials. What will be materials? Materials is $3 per unit. Labor. What's labor? Labor is a what? $8 per unit. Variable overheads. Variable overheads. What do you say? Variable overheads is $2 per unit. And lastly, fixed cost or fixed overheads. You have it fixed. Okay, fixed overheads. You have it fixed. So selling price. You say revenue. You know what makes up revenue. So revenue here, you bring it one to infinity. You have 400,000, 400,000, not in bracket. You have 400,000, and also your materials. What materials? Material you get 30,000. Labor. What's labor? Labor you get 80,000. And after labor you have variable overheads. Variable overheads. What's variable overheads? Variable overheads you have 20,000. And fixed overheads. What fixed overheads? Fixed overheads you have 10,000. 10,000. And what is this? How do you call this? Taxable profit. Okay. How do you call this? Taxable profit. How do you call this? Taxable profit. Taxable profit. And when you do all of these ones, you'll get 260,000. 260,000. What's your tax? 30%. 30% of 260,000. 78,000. 78,000. You take off tax. Is your net cash flow. Your net cash flow 600,000. You bring it. And when you take that one off, you'll be left with 182,000. Your discounting factor at this time it's 10%. So since it is perpetuity, just one divided by the discounting factor. This is 10%. Okay. The discounting factor is 10%. So 1 divided by 10%, it will give you 10. So give you what? 10. So 10 at this is 600,000. 10 at this one, I'm gonna give you 18 to double this one. It's gonna give you 1,820,000 minus. So this one will give you NPV. NPV will give you 1,220,000. $1,220,000. So you accept or deny the project? Definitely you accept. You accept the project. Okay, you accept the project. You're done. So thank you for today's class, and in our next class we're going to look at series of other things. Okay, and in our next class definitely we are going to go further into another dimension, and we are going to look at capital allowance. Okay, so thank you.